It's not often you can actually wear your asset class, but I am. So welcome to this session. I am delighted to host this session, and I have with me Marissa from the World Gold Council, Jason from Resonant, and Clive from State Street. And without them, this presentation wouldn't have come together. I'm actually just going to introduce with a bit of the emotive part to gold. It is in our Australian and world psyche. It is one of our oldest asset classes. In fact, it was supposedly discovered 3000 BC. If we wind a bit forward, it was also in our childhoods, in our fairy tales. With Jason. It was in a lovely story called Rumpelstiltskin. I don't know if you remember that, and drives back memories of your mother telling you that story. Our first gold rush was 1851 in New South Wales, actually in a town called Orange, and it was the first discovery of nuggets. Why that was important from Australia, it turned Australia from what was a colony of convicts. We suddenly had money and we turned more into cities. We didn't become a national country by then. We were just able to get more money to grow cities. On the really human pursuit side, we run for it, we cycle for it, we swim for it, we ski for it. We have elite athletes that go out of their way to train to get that gold medal for Australia. Some of their coaches will stand, and one of ours used to yell at the end of our pool, saying, "It's goddamn on the chemical elements chart, and it's AU. So of course you're going to bloody get gold for Australia." So, needless to say, I didn't, but I'm wearing gold. But we have another gold rush. And if you look at Martin Place, it's astounding. There are queues going back. I actually thought it was the Apple store had moved and the people were queuing for the mobile phone. But that had happened a month ago when the new phone came out. This gold rush has been going for the last month. So we're actually going to go through that driver of an incredible price that's gone over the 4,000, and we're also going to look at it in other pursuits of why you'd use it in a portfolio, how you use it for diversification, for returns, for liquidity, what is the percentage that potentially you should use as the diversifier. And I have got the gurus with me today to do that. So that's the emotive side of gold. And now Marissa's going to give us a bit of background on the real story of gold. Over to you, Marissa, if she's on screen.
Thank you very much, and good morning, everyone. Good morning, Francine. That was a really beautiful introduction to gold as well, and you're looking very lovely there. I can see you on the screen.
Very good.
Thank you. So I'll first start off with the introduction video about what the World Gold Council is. I think that would give us a bit of idea as to who we are. Okay.
The gold market has been evolving for decades, and the World Gold Council has actually been at the forefront of that development.
There are always new ways to think about gold, and it's our responsibility to champion those.
By being involved in every aspect of the value chain, we are able to help drive industry progress from mine to market. Gold has a critical role to play in society.
We provide data, research, and tools to investors that help them understand gold.
There is no comparable resource out there.
We have been at the forefront of responsible gold mining.
We developed and issued the Responsible Gold Mining Principles, by which the entire gold industry should act.
Gold mines add value to communities.
There's infrastructure created, from roads to schools, hospitals.
supporting the vitality of these local communities.
The key aims of the Retail Gold Investment Principles are to bring trust and understanding to the market. We are working with dealers across the world so that they demonstrate that trust to the investor.
We have developed mandatory hallmarking in India.
Hallmarking is a stamp of trust and transparency in the gold that people buy.
We have been instrumental in opening up new markets around the world.
We've worked with governments and regulators in the industry to support the development of transparent pricing information, where the gold comes from, and who is involved in that gold ecosystem.
It will help provide confidence for the investors to trade gold.
Gold 247 is our vision for transforming the gold market to meet the needs of today's consumers and investors.
We are going to see a universe where every gold bar is logged in a digital database.
Creating a digital twin of every single bar in a distributed ledger.
The benefit is to have one source and one form of gold tracked worldwide.
We are trying to make gold as usable and as friendly and as transparent to trade as any other asset class. The process of digitalization will allow that.
We lead the way in advancing the gold industry.
We are focused on only one thing. We are focused on gold. And so as a consequence, we are experts at it.
All right, so that is the introduction video. Sorry about that. Okay, so that's the introduction video. Right now I'm going to go on the slideshow. Just give me a moment. Okay, perfect. So I'm from the World Gold Council, and my name is Marissa. So today I'll be sharing the introduction about the gold market. So as you've probably heard earlier on, so we are a non-profit membership organization for the gold industry, and our key vision and mission is really quite simple. We want to stimulate and sustain demand for gold, and all in all, we want to provide the improving the understanding, access, and trust as well in the gold market. So the World Gold Council is filled with people who work with policymakers, for example, financial regulators, institutional investors, as well as to some extent retailers in the jewelry sector, for example, in China as well as India. We really want to cover the whole entire gold ecosystem, and we have the people who work with these different industry players. So I'll first start off with sharing about how much gold is there in the world, if you've ever wondered. So it really sits in this cube. So this cube is really the balance sheet of gold worldwide. If you look at all the gold that's above ground that's ever mined, and then you melt them all and put them in a mold like this, it fits into a cube. It's about 20 plus trillion right now, because the prices have gone up since the time that we did this. But in terms of percentage for jewelry, technology, as well as retail bars and coins, this means that these are in the hands of consumers. It's around 70+%, and investors have about 8% of their piece of the pie. And we also have an interesting driver of the market, which is central banks. So central banks around 17-20% right now. And looking at gold, it is really a global market. You have gold demand in all corners of the world, but more importantly, it's really an Asia-Pacific story. It's becoming an Asia-Pacific story, and it's quickly moving from the West to where we are. Around 70% of gold demand, it really sits within emerging markets. And out of that, half of it is really sitting in Greater China as well as the Indian subcontinent. So these two locations really drive the demand for gold, especially on the consumer part, when we're looking at retail bars and coins, as well as jewelry. We also have Southeast Asia, others at 11%, and Middle East at around 10%. But some of this Middle Eastern demand actually really flows into India as well. So when we look at supply is also quite global. We have gold in all corners of the world, except for Antarctica, but probably if you dig very deep, we don't know. We basically don't know if there's gold in Antarctica, but there are gold reserves in all parts of the world. Mostly it's coming from Africa, about 26% of that. We also have Oceania, which is, where we are, around 10%, and then in the Americas, we also have around 30% as well. So some interesting, you probably know this, but when we talk to a lot of investors, and then they think about, a supply shock to the market, they think that it's quite fluid. It's a bit like oil, where you can drill and put it in a barrel and send it out to the world, and then the prices can get influenced in that way. Just to put in perspective, 1 ton of ore that you crush, you only probably be able to get about 0.5 gram to 3 grams of gold. This is talking about open pit mines. When we're talking about underground mines, that same 1 ton of ore, you probably can get a higher yield, around 2.5 grams to 5 grams of gold. But the point to share this is that for the gold market, we do see supply being quite tight, but then demand is elevated based on, the factors that all of us are familiar with throughout this year. And for gold, it is an interesting asset class because it has a dual nature. The first is that it is both a consumer good as well as an investment asset. That being said, during periods of, expansion, when people are a bit more optimistic, they have high disposable incomes, we have around 40% gold demand really sitting in with the jewelry and technology. And again, for jewelry, it's really driven by demand from India as well as China. These are really huge markets for jewelry itself. When it comes to times like this, where we're a bit more uncertain about the future, we don't really know what's going to happen, a few months down the line. We have investment demand, which is accounting for another 40%, which is what we see as a current demand driver for gold, which I'll talk to in a bit. When it comes to central bank, they're a bit more cycle agnostic. They do buy gold, or they accumulate gold reserves based on a multi-year buying program. They also have a target. For example, if you've read recently, Bank of Poland said that, we've reached around 20% of our target. So we're happy with that. But the week after that, or 2 weeks after that, the governor came back out to the world and said that, look, I want to increase that from 22% to 30% of my reserves. So central banks are diverged away from maybe what's happening in the market in general, but they have a bit more of a specific agenda as to how they want to get their gold reserves and gold accumulation programs. So as you know, gold maintains its strong year-to-date performance. It's actually reached around 4,000 plus. So this was when I made that couple of weeks ago, and it's reached around 40 plus all-time highs already. And we are seeing that also comparing gold, not just in Australia, but also in many parts of the world, where as an asset class, it has lead a lot of the traditional major asset classes in local terms. So it's really the asset class that's been shining for 2025 on the back of a few different factors that you're probably quite familiar with. And another thing about gold is that when markets, or it's the future or further expectation of probably a pullback in the equity markets, for example. So this is what people have been talking about, especially in the US. Gold as an asset class is that diversifier. It becomes more negatively correlated with stocks in extreme market sell-offs compared to correlation between bonds and equities, for example. And just trying to go into the next part here, which is what is driving gold demand. So there are three key things that are driving gold demand in 2025 so far. So 2025 has been marked by a series of exogenous shocks. You can call it that way, or perhaps some people expect that, since Trump got elected. But the main thing is that there are a few drivers for gold that is separate from maybe what's driving the equities and bonds, right? The first is safe haven flows. So that's what we are seeing in gold-backed exchange-traded funds. It has had a strong start to the year with sharp inflows from North America as well as China. So just to put in perspective, in 2024, there were outflows for global gold-backed ETFs, but in 2025, it really started with a bang, and it has continued accumulating ever since. So we have the recent peak of 3,100 plus tons of gold-backed ETFs, and we are quite near that peak right now at this current point. The second part is also a story that you've probably been hearing about gold for this whole 2 years. It's probably the central bank's demand. For the first half, it has remained healthy and it's driven by emerging markets, mostly Poland, Turkey, China, India. We have some countries in Central Europe as well as Central Asia. They are the ones that have been accumulating. Do they still have room to run? You can look at it from the perspective of how much percentage of gold is there in their reserves. So a lot of these emerging markets have single-digit percentage. So for example, China, reported central bank buying has been around 7% so far. So versus, the US, which is around 75% of their reserves is actually gold. So you can probably imagine the rest of the central banks have US dollar denominated assets as well as gold in their portfolio, whereas in the US it's opposite. They've got more of their reserves in gold versus other asset classes. And again, back to the story of India as well as China. So there's gold bars and coins. This demand has been really driven by Asia Pacific so far. It's been the strongest first half that we've seen since 2013. Demand is largely driven by our region here. And just to put in perspective, global demand, right? Percentage of global demand from Asia Pacific on gold bars and coins is around 60+%. So this has really been the momentum from investors, retail investors, as well as we've got both retail and institutional investors going into the exchange traded funds. So that's me. So hopefully that was useful, and I'll pass back the time to Francie.
Thank you. That was great insights into the facts of gold versus the emotive of gold. And so now we're going to look more at the academics of gold in terms of Clive has written a thesis on gold, and in particular, how you use that in a portfolio and what percentage do you allocate to, and what are the things are we running to it for a safe haven, as Marissa commented to, or what does it play in that portfolio construction role?
Yeah, thanks. So the paper I wrote, it's very kind of you to call it a thesis. It's just more of a research paper on the potential uses of gold in a portfolio. So most of my career in investments has really been as an asset allocator. And most asset allocators, we're really comfortable with things that we can, do forward estimates on so that we can plug it into our models and put it into a strategic asset allocation. Now, gold, despite being the oldest asset class that we have, has been mentioned already, it's actually quite difficult for asset allocators to model forward-looking returns. So traditionally, it's sort of been cast aside when you're considering your strategic asset allocation. But we wanted to sort of rethink that case and sort of challenge the notion that it's been used mostly as a tactical asset allocation change to most portfolios, particularly in the wake of, disruptive events, whether it's market events or geopolitical events, or currently when the prices really run quite strongly and interest from the general public and general investors has increased. So we wanted to challenge that notion that you can actually hold gold through the cycle, through multiple cycles, and how it works in a portfolio with multiple asset classes, your bonds, your equities, and your alternatives. We think it stacks up quite well when you look at it from that perspective. In fact, probably stacks up too well, because in theory, when you do the modeling, 10, 20% allocations to gold actually work quite well. But in terms of a practical allocation to your portfolio, you probably want to stick to somewhere around the 5% mark. So 2 to 5% is where we think is a sweet spot for most multi-asset portfolios, where you get the benefits of holding gold in your portfolio, and it gives you those diversification benefits. You benefit from the price appreciation, but you also have diverse sources of returns in your portfolio as well. So we think that's where you should be pitching.
Thanks, Clive. And the paper also addresses how you access gold. Yeah. Do you want to talk through the ways in which people can access gold?
Yeah, I mean, there's been a tremendous shift in terms of how you can access gold. So Marissa's mentioned, a lot of traditional demand's been around gold bars and coins, and you see the Malines of Martin Place. People still think of gold in that way, where you want to have it physically in your hands. But we've had a tremendous shift in financial markets over the last few years, where there's been better ways to access gold for investors, and particularly ETFs and managed funds that offer you all the benefits of gold ownership without sort of some of the costs of physical ownership and the difficulties of storing it and so on. Plus, you get that financial market transparency and liquidity available to you whenever you need it. So whether you're using it as a strategic asset class or a tactical asset class, we feel some of those financial market solutions are a better solution for investors to be accessing the market. And we've seen tremendous growth in the ETF space in particular over the last few years.
Thanks, Clive. Jason, how is Resonant using it? And are you looking more at shares, ETFs, combination? Can you sort of talk us through that?
Sure. It's a combination. Running managed accounts. It's obviously limited to what is on platform. So physicals, not necessarily the easiest thing to do on a managed account, but yeah, we look at it through a number of different lenses. So on a sort of more of a total portfolio approach, so we're going to be looking at things like ETFs, or we're looking at actual funds, or we look at actual gold producers as well, so gold miners. So Newmont obviously being one of the biggest that we would see, and I guess that then is giving you a little bit of operational leverage into the gold price, and you just want to understand how they manage their hedging and forward sales as well to make sure that you're getting exposure to the right drivers in that sense.
And that particular stock not only delivers the capital, but they also tend to pay dividends. Is that correct?
Yeah. So one of the things we've always struggled a little bit with gold when it comes from particularly if you'd like talking more defensive portfolios where people traditionally want some yield out of it. When you've got a gold ETF in there, just pure gold ETF, the question is always like, well, it's not paying any yield, so it's not adding to my to my overall distribution. So a stock in the case of Newmont is a good one there, because you're actually getting a dividend out of it as well. So and yeah, you're getting sort of best of both worlds, but there is obviously a different downside scenario to that, but that does help.
Can I sort of throw it out to all of the panel in the sense that we talk about it as being negatively correlated, yet we're seeing both equities and gold steam unitedly up. So can we talk about the drivers in both those markets? Would be good. Do you want to start, Jason?
Sure. I've got a slide that I'll just pop up with some of the tailwinds that we're seeing at the moment, and I can't really even read my own slide there, but I'll just try and remember. Yeah, that's all right. But broadly, if you look at it really from a top level macro point of view, we think ultimately it's a multi-pronged story. You've got one element of this is really US dollar story. So you've obviously got you know, most of what we see in, you know, the 4,100 today in terms of the price, you know, is in US dollars. So we've been seeing a decline in US dollar value, and that's likely giving some lift to gold as a, you know, sort of a baseline. So, but then more broadly, you've really got, if you go to sort of the next level, central banks, governments worldwide, they're not backing off on their spending. They're continuing to basically look to you know, inflate their way out of debt and to a degree debase their currencies. And as a result, I mean, if you look at the US right now, and I know Trump was sort of saying he was going to address it, but current account deficit is still sitting in, I think, you know, sort of roughly about $1 trillion a year. So that's a net $1 trillion leaving the US in terms of just economic outflows, created but leaving. Now, if you go back 20, 30 years ago, a lot of that would have really been kept in US dollars and stored by central banks as reserve currency. That's not happening as much anymore because we've got a lot of obviously big shifts in the way that the world's being structured at the moment. And as a result, a lot of those central banks, this is back to what Marissa was saying about central bank activity, particularly in Southeast Asia, they're not holding those US dollars, they're looking for something else. So that something else at the moment, in some cases, is gold, and they don't necessarily have like the sensitivity to buying it from a price point of view that a lot of other retail groups would, or traders. So they're just buying it on a program because they've been mandated to by the government or by you know, by their parliament. So that creates, you know, like really one-way demand in that respect.
Yes. Also, in terms of what Ms. Rose spoke about, in terms of what the World Council is trying to do is digitalise it and therefore give it an even keel for price valuations and therefore making it more tradable, easily tradable, I suppose. Commenting on that in terms of what you're saying in terms of funds management, how they're accessing, where we're going in terms of that. And Marissa, please, I can't see you to chime in there. Because I think in terms of platform.
Sure.
Oh, sorry, Marissa.
Yeah, sure. Yeah. So, so the World Gold Council recently had a white paper on the framework on digitalization of gold. So the idea is that we want to, so firstly, people can have access to gold through the allocated gold as well as the unallocated gold. There's also a third way where, you know, they get a piece of an unallocated gold gold bar using X point Y ounces of allocated gold bar. So basically, you just want to make sure that you're able to fractionalize a gold bar and make sure that someone can have a claim to it. And if that is traded, it will be assigned to the next fractional bar. So at the end of the day, you have some gold bar that you're able to track. So there are some players in the market, I'm talking about, you know, Singapore, that have been doing this or have been trying to, you know, market out fractionalization of gold, and the idea is also quite the same. What the World Gold Council is trying to do is that we're trying to build an ecosystem for this, and the main aim is that to make sure that, you know, the gold access it can be fractionalized 1 out of, you know, 1,000 or 1 out of, you know, more than that, so that people can have access to that ecosystem as well.
I think it's going to be tough to do that. And I just sort of let's go to a scenario where you've got a vault of gold that you've got an NFT, fractional NFT over the top of that, so non-fungible token, so like digital rights over that. There's a military coup in that country, and then you turn up with your digital token and say, oh, that's mine, and they're like, on your bike, mate. Like I don't know how that works. Like if you're holding it under the worst case scenario, you can't do any other thing than hold it physically, to me. So if you've got stable government, you've got a surety of that link between the token and the physical asset, that's fine. But it depends what you're holding gold for. So I'd say that if you're holding it for end of days, you really probably want to have your coins. Well, your silver, actually. We were talking about this before. So silver's probably better in an Armageddon scenario because it's a smaller value. They'll shoot you for your gold coin.
Yeah. And so in that sense, we've talked about ETFs, we've talked about funds, we've talked about fractionalization and perhaps that pursuit of making it much more easily tradable and accessible than the physicality of the gold. You also talked about ETPs and how that works with the Perth Mint. Talk through that.
Yeah, so that I quite like that Perth Mint. I don't know if anybody's familiar with it, but you can, so ETP is exchange traded product, and it basically gives you rights over physical gold at the Perth Mint. So there's a few steps involved. You can buy it on the exchange, on the ASX, and then you can actually elect to convert it into a Perth gold allocation, and then you can actually turn up there and say, I physically want it. So, so that, I think at least that's within a contained ecosystem. And I think that's actually a pretty cool sort of approach to do it. But there's cost in converting, so you're paying a fee to do that at a number of different steps. And then you've still got to get KYC before you turn up. You just can't turn up with a share certificate. So I've never done it myself, but I read about it. It seemed pretty cool.
It is, in a sense, we're using it for a defensive means, but actually it's actually tagged as a growth asset, is it not? And so that sometimes causes issue in how you use it. Do you want to talk through, either of you, to talk through that?
Yeah, sure. I think I alluded to it earlier in terms of, the asset allocator's dilemma is where do you put it into, do you put it as a defensive asset, or do you put it as a growth asset, or do you put it as an income asset? And we know the challenges of doing any one of those things. But we think instead of sort of focusing on those top level categorizations, I think you put it into a portfolio. What it actually gives you in a portfolio is better defensive characteristics than some of the alternatives that people are turning to right now. So as a portfolio holding, it improves your risk return profile of that portfolio. Never mind what the return profile is of gold at the particular moment. I think through time, over long periods of time, it does help the portfolio volatility, particularly in terms of market stress. So I think it's very difficult to predict those times when those times happen, but I think you will see the performance there. So I think as a whole, it probably would qualify as a defensive allocation in a portfolio.
So what are they selling to get the allocation to gold?
Well, we've seen a variety of things, but it tends to be more equity holdings, actually, as a hedge to your equity holdings. But we think it actually acts as a hedge to a 60-40 or multi-asset portfolio. So you can sell out of your bonds, out of your equity. So in the paper that we did an exercise where we were taking allocations out of different asset classes to see the impact that it has on portfolios. And it was a pretty similar impact whether you took it out of bonds or equities in terms of the impact on portfolio risk. But the example we presented takes it equally out of equities and bonds and allocates it to gold, and you do get that benefit coming through.
Brilliant.
Yeah, I mean, it's a pretty tricky one, right? I mean, because platforms and most people are going to categorize as an alt, and then an alt is generally growth. But, the way that we've sort of used it interchangeably at times for that more of a alt defensive play, I guess, or something that has a lower or negative correlation. There's an ETF called T-bill, which is like US Treasuries, and some of our clients prefer that because it's got the yield, so you get paid yield, and it's sort of like a very short-term bond. So if there was, effectively emergency rate cut by the Fed, then that's going to kick under that scenario, and gold will probably do a similar thing, but obviously gold doesn't pay dividends. So, so we sort of sometime when we've done the modelling on them, outside of those real big extended market sell-offs, they sort of tend to work reasonably well in the short term, but the longer term, gold's obviously done very well lately. And even if you look, so 2 examples just in the last sort of period of time, even just recently, like the was it 2 days ago when the market sold off when Trump said something, you had gold was actually really the only thing I saw on the screens that was really up. So even despite all the strength we've had over the last few sort of year or two. And then, but then on the flip side of that, if you look at COVID, gold was actually down for a couple of days in the worst of it because people were just liquidating everything. They were just trying to raise cash. So it may not always behave exactly how you think in that short-term correlation stage, but longer term, it obviously through debasement of currency and as things are inflating, gold obviously holds its value generally. We've seen that as pretty observable now.
Yeah. Yeah, I'd add that humans don't normally behave as we expect. So between Marissa, Jason and Clive, are we going to put a golden crystal ball and indicate where we might see this run end and where we think a range is in dollar value? Not that I'm putting you on the spot, but I am.
So I'll start with a bit of a confession. So we've had 3 bull cases for gold for 2025 in the last 12 months, and gold's blown through all of those bull cases. So I think my record in terms of predicting where this price will end is not great. But I will say, given gold's a really topical issue at the moment, and a lot of people sitting in this room are probably thinking, I don't have an allocation to gold. It's already at 4.1. I think it's too late. I don't think so. I think, as we said throughout the session, gold has more roles to play in a portfolio than just price appreciation. So I think it's not necessarily too late just because the price is at all-time highs or whatever it is. So that's my take. I'm gonna.
Thank you for that admission, Clive, too. Jason?
So I did this panel last week in Melbourne. I'll say the same thing. At least a 51% chance it will be higher.
51%.
Which means that technically I'm bullish on it.
Yeah,
So,
technically.
but compliance doesn't like me to give numbers out. So, but yeah, look, I think, as per the slide, there's a lot of tailwinds. I think the only thing that could potentially be a headwind to it is allocation into other alternative, sort of commodities or, copper. People probably haven't been picking up. I don't know if anybody's watching copper price lately, but that's been absolutely screaming. Silver's over $50, overnight, I think. So there are other things you can go into to get the same sort of protection if your view is on the macro side of things around why it's doing what it's doing. If you just want to have gold because you want gold, and if you'd want to go and join the queues down Martin Place just so you can have then that's sort of a different short term. So, but yeah, I think longer term, it's got a lot going for it.
And Marissa, I know that the World Gold Council isn't supposed to comment on this. So any last comments from you?
Yeah, sure. So I think what we do at the World Gold Council is really research, historical data so that we have something to look back on. And our recently released blog, really at Gold at 4,000, dives into that, the different historical bull runs and how much gold is in the accumulation phase. So I think not trying to put numbers or comment, but I think the blog also details where we are in the cycle. So I think it's worth a shot to have a look at that as well. And again, echoing all the other panelists, I feel that there's a lot more opportunities for gold going forward in 2026 based on the different macro drivers that we're seeing so far.
Brilliant, thank you. And I think Toby now would like to open up the floor to questions from...
Stephen, do you want to... Gold, like any asset, capital goes up with supply and demand. Obviously big demand now because there's lots of turmoil and all those reasons you've given. But just looking at the graph going back 100 years here, and there are decades, like from 1980 right through to the 2000s, where it's done zero. So as an asset allocator, I'm going, gosh, here we are. It's really gone through the roof now. But when it was like $200-400 an ounce, then it creeped up to 1,000 an ounce, 2010 from 2000. Can you see sometime in the future, Democrats are in the US, Ukraine's done and dusted, Russia's gone, things are happy and normal on the planet. have you done any forecasting of what, would you still hold your 2 to 5% in gold as an asset allocator?
Yeah, it's a great question, and I should have mentioned it earlier. So the exercise we did covered about 30 years of history, and in that 30-year period, you did have sort of I'd say 15 years of lost, a decade and a half lost in terms of no price appreciation from gold. So sort of from about 1995 to about 2004, and about 2011 to about 2018, gold did like nothing, 1% a year in terms of cumulative growth. Even in those periods, we isolated just an allocation to gold in those periods. Gold's role as a diversifier was still very, very prominent. And in those times, we had things like the Eurozone crisis, we had the tech crash and so on. And so you still had benefits coming from a gold allocation at those levels of 2 to 5%. And that's another reason why we wouldn't recommend going sort of to the 10, 20% allocations, because if you do experience another sort of lost decade, you're not sacrificing overall portfolio return to get that diversification. So it still stacks up even when gold does nothing. And I think that's an important point to make at this time when gold's at record prices.
That white paper that Clive talked about, State Street have given us a copy, and that's circulated to everybody, or will be circulated to everybody who's registered. Other questions? Yeah, Rob.
Thanks. Just a suggestion to the producers of product out there. There's a new strategy you should work on called GARP, gold at a reasonable price. So I look forward to an ETF on that. I'm interested, following on from that particular comment, I wonder if you substituted T-bill for gold through those periods, that would have been equally a diversifier, because really the diversification was gold wasn't moving when everything else was moving around it, and T-bills don't basically move in their capital value. Same with bank bills here or whatever. So there's an idea there that gold's diversification benefit is certainly there, but there are other things that can provide that benefit. But what I'm curious about right now, it strikes me, there's a couple of things going on. One is the taxi driver phenomenon, like a stock bubble is one indicator is the taxi driver's giving you stock tips, right? In gold, that equivalent indicator, queues along Martin Place for people selling their jewellery, divorcees selling their wedding rings, pulling out their fillings and melting them down, etc. The last time I remember seeing that happen was, again, like a peak in the gold price. And both of those things also coincided with this massive uplift in price. The momentum recently is just insane. So if you look, and I've done this exercise, if you look at the 200-day moving average of gold versus where it is at that point in time, the difference right now is as high as it's ever been in 30 or 40 years. And the last time it was near that was, again, at another major peak in the price. So I agree with lots of the benefits that you've mentioned about gold and the supporting mechanisms for it right now. But I just wonder where we're at right now is a bit of a blow off in price where it's, I don't know how safe it is to buy at that level. So maybe you could comment on that.
I'm not advocating that you go out and buy it now necessarily from a exactly from an aggressive point of view. But look, if you look at it currently on a valuation basis relative to other assets, right? So if you look at it on a ratio basis, because it's very hard to sort of say, well, what's it worth? Outside of Sydney housing market, it's probably the most expensive it's ever been. Like, and I sort of say it a little bit jokingly because nothing's more expensive than Sydney housing. But when you look at it relative to other other commodities, other assets, equities, whatever it might be, it is at the way end of the range. So, but if you then step back and sort of say, well, why? There are a lot of reasons around why this is happening, and I think that there is really tectonic shifts around the way that you're getting rewiring in global you know, especially central bank policies and the way that, you know, China, India, Russia are approaching the way they're going to manage their balance sheets going forward. And it was like, I mean, I saw a talk about this a while ago, because when they were sort of like trying to push a new BRICS currency sort of thing, one of the Middle Eastern sovereign wealth funds was put on the spot and said, well, would you be happy swapping out 20% of your US dollar reserves for this new BRICS currency? And they just said, no way. So where else do you go? There's not a lot of other options, and that, I think that's really what it comes to. I don't think the punters down Martin Place are shifting the price. I think it's central banks that continue to buy, and the problem is that they just say, we've been told we've got to go and buy it, and they're just going to buy it. So I can't predict when that's going to stop, but I do think that's what's the driver behind it, and it probably does get out of control. So.
Thank you, guys. Thank you, Marissa, Jason, and Clive.